Welcome to Griffonomics.
Glad to be here for this one.
Yeah, you're joining us for a brand new deep dive today. And usually when we talk about treating cancer, our minds immediately go to the operating room, right?
Absolutely. Bright lights, general anesthesia.
Exactly. The physical trauma of the scalpel. It's highly invasive, incredibly taxing on the human body. But it's just, the unquestioned standard of care.
Yeah, it's the fundamental trade-off we've normalized in medicine for decades. You have to cut it out to survive.
But looking through the stack of sources we're diving into today, we've got a really fascinating collection of financial reports, earnings call transcripts, and biotech analyst notes. We're seeing a fundamental shift.
A massive shift, really.
Yeah, that traditional operating room looks like it might be facing an existential threat. We're tracking a medical landscape that's trying to move the front line of cancer treatment away from the surgical table and directly into the local outpatient clinic.
Right, which is the absolute definition of paradigm disruption. And the mission of our deep dive today is to conduct a granular investigative report into the company at the epicenter of this shift.
That's UroGen Pharma, trading under the ticker URGN.
Exactly. We're going to explore their fundamental transformation from this niche oncology biotech into an emerging commercial powerhouse.
And whether you're actively analyzing biotech investments for your portfolio, or you're just fascinated by how medical innovation disrupts these established surgical practices, you really need to pay attention to this one.
Yeah, because UroGen represents the ultimate case study of high risk meeting high reward.
To put it bluntly, they are trying to replace the surgical scalpel with a chemical gel.
Oh, which is wild. And to understand how audacious that goal is, before we even touch the financials or the market dynamics, we have to look at the underlying science driving their entire business model.
The RTGel technology.
Right. Everything UroGen is attempting sits on this proprietary foundation called RTG.
Okay, let's unpack this. So RTGel is a reverse thermal hydrogel, which sounds incredibly sci-fi.
Does sound like sci-fi, yeah.
But mechanically, it's brilliant. It's a biocompatible polymer that stays as a free-flowing liquid at colder temperatures, but the moment it hits body temperature, it aggressively transitions into a semi-solid gel.
A rapid phase change.
Yeah, I kind of think of it like a reverse Jell-O, or maybe a smart sponge. But let's get into the biology here. Why does turning into a gel actually matter for treating cancer?
Well, it all comes down to two critical words in pharmacology, which are dwell time.
Dwell time.
Right. Think about the anatomy of the human urinary tract and the bladder. Their entire biological purpose, optimized over millions of years, is to flush liquids out of the body as quickly and efficiently as possible.
Right, keep things moving.
Exactly. So if a doctor administers normal water-based liquid chemotherapy into the bladder, the physiological flow of urine flushes it out in a matter of minutes.
Just washes it right away.
Yeah. Often the tumor is exposed to the active drug for less than an hour.
It's like trying to clean a microscopic, deeply embedded stain on a slanted driveway with just a quick splash of water.
That's a great analogy.
It just runs right off into the gutter before the soap can even activate.
And that biological flushing mechanism is the exact hurdle UroGen's gel was engineered to solve.
Because it goes in cold.
Right. The RT gel is chilled to a liquid state in the clinic, so a doctor can easily instill it directly into the upper urinary tract, or the bladder, using a standard, minimally invasive catheter.
So no general anesthesia required.
None at all. But once that chilled liquid enters the body, the internal warmth immediately converts it into a highly viscous gel.
Which is the reverse Jell-O effect.
Exactly. It physically conforms to the unique anatomy of the patient, coating mucosal tissue, and forms a temporary targeted reservoir right on top of the tumor.
So it locks the chemotherapy in place.
It creates a sustained release environment. That gel gradually dissolves upon contact with urine, slowly releasing the active chemotherapy drug, in this case, mitomycin, over a period of up to 24 hours. Yeah, and for their bladder cancer drug specifically, the median dwell time of exposure is about 5 hours.
So you're going from 5 minutes of fleeting exposure to 5 hours of sustained, concentrated chemical exposure.
It's transformative for the tissue.
That is a massive biological difference.
It really is. And this RT gel technology currently powers UroGen's 2 approved commercial products. First is Jelmyto.
Right, the older one.
Yeah, approved back in 2020 for low-grade upper tract urothelial cancer. Now, that's a smaller, somewhat niche market, but it's been a reliable foundation. It generated about $94 million in net revenue in 2025.
But looking at the analyst notes, the real star of the show right now, The core reason UroGen's revenue engine is actively transitioning to a multi-product mix is their newer drug, Zusduri.
Zusduri's the big one.
Yeah, approved in June 2025. Zusduri is designed for a significantly larger patient population, right? Adults with recurrent low-grade, intermediate-risk, non-muscle invasive bladder cancer.
Let's actually pause there and look closely at that medical classification.
Okay.
Because non-muscle invasive isn't just a label. It's the biological reason this entire business model is even possible.
Right, because if the cancer has deeply invaded the muscle wall of the bladder, a surface-level gel isn't going to save you.
Not at all.
You still absolutely need a surgical intervention to cut out the compromised muscle tissue.
Precisely the distinction we need to make. Zusduri targets tumors that are strictly residing on the inner lining of the bladder.
The urothelium.
Exactly. Because they haven't breached the detrusor muscle, a surface-coating gel is uniquely suited to attack them.
Makes sense.
And that specific larger market is what defines UroGen's massive economic moat. To understand the value of this gel, you have to look at the brutal reality of what it's actually replacing.
The current standard of care.
Yeah, for superficial bladder cancer patients, it's a surgical procedure called TURBT.
Transurethral resection of bladder tumor.
That's the one. It is a highly invasive surgery performed in a hospital setting, usually under general anesthesia.
Which is intense.
Very. A surgeon essentially goes in and scrapes or burns the tumor off the bladder wall. It carries significant risks like heavy bleeding, severe infection, and even the risk of perforating the bladder entirely.
Oh, wow.
But the most devastating aspect of this specific disease profile is the recurrence rate. Up to 70% of these patients will experience at least one recurrence of the tumor.
70%.
Yeah. And about 68% of those recurrent patients will face 2 or more recurrences.
Meaning they are subjected to repeated compounding surgeries.
Exactly.
So a patient recovers from the physical trauma of having their bladder scraped just to go back under the knife and endure the exact same trauma a few months later when a new tumor pops up.
And approximately 23% of these recurrent patients endure 5 or more of these TURBT surgeries over their lifetime.
That is just brutal.
It takes a devastating toll on their physical health, their mental well-being, and overall quality of life. The clinical data points out that patients who've had 2 to 4 TURBT procedures face an estimated 13% greater risk of overall mortality compared to those who've only had 1.
So every surgery degrades the body.
It does. And UroGen's stated mission is to completely disrupt this endless surgical cycle with a concept called chemical ablation.
Okay, I have to push back on the mechanics of that, though.
Sure.
They are telling highly trained surgeons to put down the scalpel, abandon the operating room, and pick up a catheter in an outpatient clinic.
That's the pitch.
But is a gel actually robust enough to replace a physical surgery? Like, a surgeon's scalpel physically severs and removes the tumor mass from the body? Can a chemical gel genuinely achieve that level of eradication?
Well, the clinical trial data from your sources provides a very compelling answer to that exact skepticism. Not only is the currently approved Zusduri proving highly effective, demonstrating complete response rates of nearly 80% at 3 months across various risk groups, but UroGen is already aggressively developing a next-generation sequel drug.
Called UGN 103.
Right. And this sequel is engineered with a shorter, more streamlined manufacturing process. In its phase 3 trial, UGN 103 just demonstrated a 77.8% complete response rate at the 3-month mark.
Wait, just to clarify the medical terminology there, a complete response doesn't mean the tumor shrank a little bit.
No, not at all.
It means in nearly 78% of these patients, there was absolutely no detectable disease remaining 3 months after the gel treatment.
0 detectable disease.
Almost 80% eradication without a single surgical incision.
It is a staggering efficacy profile for a non-surgical intervention.
It really is. But having a disruptive, highly effective, non-surgical treatment only matters if you can actually get it to the patients.
Getting it into the clinics.
Right. And getting it to patients means doctors have to be able to afford to use it. Which brings us to a massive, critical inflection point for UroGen's survival.
The January 2026 J-code catalyst.
Yes. Going through the financial transcripts, this is the date that flashes like a neon sign for analysts, January 1st, 2026.
That's the day.
This is the exact day a permanent Medicare J-code, specifically J9282, went into effect for Zusduri.
And to understand why a seemingly boring billing code is the single most important catalyst in this company's history, we need to explore what the industry calls the biotech danger zone.
Sounds ominous.
It is. It's that perilous, terrifying gap between a drug receiving FDA approval and the company actually proving the drug is commercially viable in the real world.
Because a biotech firm can invent an absolute medical miracle, but if the reimbursement logistics for the doctors are a nightmare, the drug will just fail.
Exactly. Let's paint a picture of how that actually works on the ground. Prior to this specific J-code, if a local community urology clinic wanted to use Zusduri to save a patient from surgery, they couldn't just write a prescription.
Right, under the buy and bill model.
Yeah, that small clinic had to purchase the expensive gel up front, floating the cost on their own limited balance sheet.
Which is a huge risk.
Then they had to administer it to the patient and spend the next 3 to 6 months fighting with Medicare and private insurers using generalized, non-specific billing codes.
Hoping to eventually get paid back.
And community clinics operate on very thin margins. They simply cannot afford to take on the financial risk of floating tens of thousands of dollars in drug costs while arguing with insurance adjusters.
So, despite the brilliant science, they take the safe financial route.
Yep.
They refer the patient out to the massive hospital system for traditional surgery because the hospital has an army of billing specialists who can absorb that friction.
That is the biotech danger zone in a nutshell. Great drug, zero adoption because of the paperwork.
But the permanent J-code changes the entire equation. Because J9282 is a permanent product-specific billing identifier. It essentially signals to every billing department and insurance algorithm in the country that this is a standard, fully covered, routine procedure.
It completely removes the reimbursement friction for the community urologist.
Yeah.
They know exactly how much they will be reimbursed and exactly how fast the check will clear.
And looking at the earnings data, the market shift was immediate and violent.
Oh, overnight.
The sources note that in 2025, during that early launch phase without the permanent code, utilization of Zusduri was heavily skewed. Like 60% of all treatments were happening inside those massive hospital systems.
Right.
But by late February 2026, just weeks after the J-code went live, utilization rapidly shifted to a 50-50 split between hospitals and community practices.
Because the J-code didn't just make the drug marginally easier to bill, it unlocked an entirely new, massive segment of the healthcare market.
The community clinics.
Yeah. Exactly. Community urologists who were sitting on the sidelines, watching the impressive clinical data but fearing the financial risk, are now actively adopting the therapy into their daily workflows.
Which is huge for revenue.
Management reported a clear acceleration in new prescribers and patient enrollment forms, figures that are currently surpassing even their own historical launch metrics for their first drug, Jelmyto.
But, and this is a big but, unlocking that massive community market is only half the battle.
Always a catch.
Scaling up a commercial launch, hiring the sales force, manufacturing the supply, educating the doctors requires an absolute mountain of cash.
A mountain.
And looking at the FY 2025 financial receipts, that mountain was eroding incredibly fast.
The financial realities of commercializing a disruptive drug are always sobering.
Yeah. So for the full year 2025, UroGen reported total revenue of $109.8 million.
Which is a solid 21% increase year over year.
True. Jelmyto was the steady workhorse, pulling in $94 million. But Zusduri is where the growth narrative lives. Zusduri generated $15.8 million during its foundational launch year, but the quarterly ramp is what analysts focus on. It accelerated from $1.8 million in Q3 all the way up to $14 million in Q4.
A phenomenal trajectory heading right into the activation of the J-code.
Yeah.
But that kind of quarter-over-quarter commercial acceleration comes at a severe price.
And here is the terrifying part for anyone holding the stock. UroGen's 2025 operating cash burn was a staggering $162.4 million.
Wow.
Yeah, they reported a net loss of $153.5 million for the year. It's like trying to build a rocket ship while your fuel tank is leaking $160 million a year.
That's exactly what it's like.
When you are burning that much just to keep the lights on and fund a commercial launch, your margin for error is effectively zero. Any stumble in option and the company goes under.
And management was acutely aware of that ticking clock.
Yeah.
To fix this glaring liquidity crisis, URGN executed what financial analysts are calling a structural masterstroke.
Okay, what did they do?
In February 2026, they closed a refinancing deal with Pharmacon Advisors for a senior secured term loan of up to $250 million.
Wait, in a macroeconomic environment with elevated interest rates, taking out a $250 million loan to plug a 160 million burn rate sounds like financial suicide.
It sounds reckless, sure.
How do they justify taking on that much leverage without completely tanking their long-term balance sheet?
Well, the justification lies entirely in the exceptionally favorable terms they negotiated.
Okay.
They drew an initial $200 million tranche at closing. They strategically used $125 million of that to immediately pay off their existing, much more expensive legacy debt,
I see.
and then dropped $75 million of fresh, non-dilutive capital directly onto their balance sheet to fund the ongoing Zusduri launch.
So it wasn't just piling on new debt, it was a strategic refinancing to radically improve their cost of capital.
Exactly that. They lowered their interest rate from a highly volatile variable rate that was sitting around 12% down to a stable fixed rate of 8.25%.
Oh, that's a massive drop.
Locking in a fixed single-digit rate on a loan of this magnitude right now is an incredible victory for their CFO. Furthermore, they negotiated to push the start of the principal repayment all the way back to the first quarter of 2030.
Buying themselves time.
Yeah, they bought themselves 4 clear years to build the business before the heavy bills come due.
And reading through the loan details, there's one line that really stands out to me. There are 0 financial covenants associated with this amended loan.
Which is practically unheard of for a high-burn biotech.
Right. It means the lender isn't putting strict minimum revenue requirements or cash-on-hand thresholds on them. There are no artificial quarterly tripwires that could trigger a technical default if, say, a clinical trial gets delayed by a month.
Pharmakon essentially gave them a highly flexible $250 million long-term lifeline. This represents a massive vote of institutional confidence.
They believe in the gel.
The lender looked at the clinical efficacy, analyzed the immediate J-code adoption data, and decided to bet $250 million on UroGen's ability to execute over the next 4 years.
And with this deal finalized, UroGen's pro forma liquidity jumped to an estimated $245.5 million, securing their runway.
Exactly.
So, with the balance sheet heavily fortified until 2030, the sources show UroGen is not just sitting still and resting on Zusduri. They are aggressively managing their future pipeline, which involves some really fascinating M&A, mergers and acquisitions activity.
Because when your burn rate is still historically high, strategic capital allocation isn't just a buzzword. It's a survival mechanism.
You have to be ruthless.
You have to be ruthless with your research and development budget.
Let's look at the timeline of that ruthlessness because it tells a story of shifting priorities. Early in 2025, UroGen made a bold move, acquiring an entirely new asset from a company called Iconovir.
Right.
It's an investigational oncolytic virus, now designated UGN 501, which is engineered specifically to target high-grade cancers. They are planning a phase 1 clinical launch for it in late 2026.
A huge pivot.
But then, later in the year, in November 2025, UroGen completely discontinued the development of their own internal immuno-oncology asset, UGN 301.
Yep.
So why kill off your own drug development just to buy a new virus from someone else?
Well, it comes back to constantly prioritizing the highest yield assets to protect the broader portfolio. UGN 301 was likely hitting unforeseen development hurdles or simply wasn't meeting management's internal benchmarks for efficacy relative to its ongoing clinical costs.
Right, the juice wasn't worth the squeeze.
Exactly. When you are leaking $160 million a year, you cannot afford to let ego get in the way and throw good money after bad. By cutting 301, they immediately freed up vital capital.
And reallocated it to the new virus.
Precisely. Acquiring the Iconovir asset allows them to leapfrog into a much more promising biological mechanism of action.
These oncolytic viruses are fascinating.
They really are. They selectively replicate inside cancer cells and destroy them while leaving healthy tissue alone. UroGen bypassed the expensive, high-risk early discovery phase by buying an asset that was already primed to the clinic.
It's essentially planting a flag in the high-grade cancer market, which is significantly more deadly, more complex, and more lucrative than the low-grade markets they currently dominate.
Absolutely.
But they are also protecting their current turf by utilizing what the analyst notes call a sequel drug strategy. We mentioned UGN 103 earlier, the drug that hit that massive 77.8% complete response rate.
Right, the phase 3 data.
That drug is literally just the next generation optimized version of Zusduri. They plan to submit a new drug application for it in the second half of 2026.
And they are executing the exact same playbook with their legacy drug, Jelmyto, actively developing a sequel called UGN 104.
So they're upgrading the whole lineup.
The strategic thinking here is brilliant. Both of these sequel drugs combine UroGen's existing proven RTGL technology with a proprietary new formulation of mitomycin that they licensed from a pharmaceutical company called Medac.
Okay, why does that matter?
This new formulation significantly shortens the complex manufacturing process and streamlines the reconstitution process for the doctors in the clinic.
Make the drug faster to manufacture, make it easier for the nurses to mix, and you increase adoption.
Exactly.
But the transcripts show management is planning to be incredibly careful with this rollout. When UGN 103 is officially approved, they plan to rapidly and forcefully transition the entire market off the older Zusduri and onto the new 103, specifically to avoid confusing the doctors with overlapping products.
It requires a very delicate logistical dance. You don't want your own products cannibalizing each other's sales, while community clinics are still just getting comfortable with the new billing codes.
Now, listening to all of this, it sounds like a remarkably smooth path to profitability. They have highly disruptive tech, a fully funded runway through 2030, a permanent J-code driving adoption, and smart pipeline management.
It sounds great on paper.
But if you were looking at the space, the sources point to a few massive existential landmines that you need to be aware of. There's a reason analysts tag this stock as high risk.
The market skepticism is very real. And the bear thesis centers on two major, heavily interconnected threats: generic drug competition and looming exclusivity cliffs.
Let's start with the immediate legal threat, which is the Teva litigation. Teva Pharmaceuticals, which is an absolute titan in the generic drug manufacturing space, submitted an application to the FDA attempting to launch a generic version of UroGen's first drug, Jelmyto.
A direct challenge.
UroGen aggressively sued them for patent infringement, and there is a high-stakes bench trial scheduled for October 2026.
And this litigation exposes the core vulnerability of UroGen's intellectual property. The active chemotherapy drug used in both Jelmyto and Zusduri is mitomycin.
Okay.
Mitomycin is an incredibly old drug. It has been utilized in oncology for decades. It is entirely in the public domain and completely off patent.
Wait, really? So UroGen doesn't actually own the patent on the underlying chemical that actually kills the cancer cells?
No, they do not own the mitomycin. UroGen's entire multi-billion-dollar economic moat relies exclusively on their formulation patents for the RTGel delivery system. The commercial magic isn't the mitomycin itself. The magic is the proprietary hydrogel that holds the cheap generic mitomycin against the bladder wall for 5 hours instead of 5 minutes.
So Teva is essentially walking into court arguing, we don't need your mitomycin, and we can figure out how to manufacture a temperature-sensitive gel that achieves the same dwell time without legally violating your specific formulation patents.
That is the exact generic playbook. And while UroGen has successfully defended its RTGel patents in the past, pharmaceutical patent litigation is always a roll of the dice.
For sure.
A single adverse ruling from a judge could invalidate their moat overnight. But even if they win in court, there is a bigger, unavoidable ticking clock, the exclusivity cliff for Zusduri.
June 2028. That is the exact month when Zusduri's regulatory exclusivity officially expires.
Right.
UroGen argues their core patents extend out to 2031, but that 2028 date is the moment when generic challengers are legally allowed to start knocking on the FDA's door with copycat formulas.
Which means this current 24-month window is an absolute do-or-die period for commercial adoption. Management does not have the luxury of a slow, decade-long educational campaign to gradually convince urologists to change their deeply ingrained habits.
They need it to be standard right now.
They need to establish Zusduri as the unquestioned habitual standard of care, deeply embedded in the daily workflows of thousands of community clinics long before 2028.
Because if they achieve massive entrenched market penetration, generic challengers will have a much harder time displacing them.
Exactly. But if this commercial launch stumbles, UroGen will find themselves fighting a brutal multi-front war against their own high cash burn and an army of cheap generic copycats.
And just to add one final layer of macro risk to the thesis, UroGen is officially headquartered in New Jersey, but according to their SEC filings, a significant portion of their core research and development, and crucially, the actual physical supply of the RTGel itself, is heavily concentrated in facilities in Israel.
Right, which introduces geopolitical risk. Given the historically volatile political, economic, and military conditions in that specific region, any significant disruption to their Israeli operations could directly and immediately impact their supply chain.
If they can't manufacture their RTGel, they have no product.
It is a severe external risk factor that is entirely outside of the executive team's control, but one that institutional investors are monitoring very closely.
So, weighing all of these complex factors, the incredible disruptive potential of chemical ablation, the massive $5 billion total addressable market, balanced against the ticking clock of generic threats and geopolitical supply chain vulnerabilities, brings us to the final verdict from the analyst
The
notes.
$1 billion ceiling.
Right. Analysts covering the biotech sector are currently viewing UroGen through a very specific, highly polarized lens. The consensus rating is a strong buy, but it is universally tagged with a high-risk warning.
High risk, high reward. UroGen's management team is officially targeting greater than $1 billion in peak annual sales for Zusduri.
Over a billion.
Yeah, they believe they have roughly a 4-year ramp to hit that lofty peak. And the math is there. The total addressable market for these recurrent, non-muscle invasive bladder cancer patients is estimated at about 82,000 eligible patients annually in the United States alone.
So a massive pool of patients.
The financial projections model out beautifully if the current acceleration we're seeing from the J-code activation holds.
If it holds, yeah.
If community urologists truly adopt and maintain this 50-50 split with hospitals and continue to aggressively scale up their weekly treatments, analysts project that UroGen could cross the threshold into total company profitability by 2027.
Wow, 2027. By the end of 2026, the models are estimating Zusduri sales alone could hit $150 million.
Which is huge.
Combine that with a steady $100 million baseline from Jelmyto, and you are sitting at $250 million in annual revenue. At that point, they're rapidly closing in on the break-even point against their projected $240 to $250 million in operating expenses.
But if we synthesize all these sources and connect this back to your perspective as someone trying to understand the future of this sector, you have to recognize UroGen as a classic asymmetric risk-reward setup.
So boiling it all down, what does this actually mean for the listener tracking the space?
It means this is not a quick speculative flip. It is a multi-year thesis that hinges almost entirely on the complexities of human behavior.
The doctors.
Right. Yes, the underlying science, the RTA gel, is brilliant. Yes, the Pharmacon refinancing masterfully secured the balance sheet. But the entire billion-dollar valuation of this company rests on one singular unknown, whether a stubborn, highly trained community of surgeons is willing to permanently put down the physical scalpel they've relied on for decades and trust their patients' lives to a simple chemical gel.
It's the ultimate test of medical disruption. So, to briefly recap our deep dive today, UroGen Pharma is leveraging a brilliant temperature-sensitive gel to disrupt a $5 billion bladder cancer market.
A huge market.
They're backed by a fresh $250 million financial lifeline. The new Medicare J-code has blown the doors open for rapid community clinic adoption, but they are racing against a massive $160 million cash burn, looming 2028 exclusivity cliffs, and generic drug giants actively trying to invalidate their entire intellectual property moat.
It is a phenomenal, high-stakes case study, and it raises a profound question about the future of healthcare, something I'd like to leave you to ponder.
Let's hear it.
If UroGen successfully proves over the next 24 months that a complex recurring surgical procedure like TURBT can be effectively and safely replaced by a simple outpatient chemical gel, what other highly invasive surgical standards of care across the medical field are ripe for chemical ablation disruption?
That's a great question.
Are we entering a new medical era where the traditional operating room is increasingly replaced by the outpatient clinic?
It's a fascinating question, and one we'll be watching closely over the next 24 months as this commercial data unfolds. Until next time, risk defined, portfolio protected.